What is a Roth conversion? Should I do a Roth conversion? How much does a Roth conversion cost? Are all questions I get on almost a daily basis. And today I'm going to take some time and answer those questions and discuss a few scenarios in which a Roth conversion may make sense for you. My name is Spencer Ford, Certified Financial Planner with Conservative Financial Solutions. What is a Roth conversion? Put simply, a Roth conversion is a transfer of retirement assets from a traditional IRA to a Roth IRA, which creates a taxable event. So why would you do that? Why would you intentionally take money out of your traditional IRA or 401k and transfer it to your Roth IRA or Roth 401k just so you can pay tax? What's the benefit? One benefit is money in a Roth IRA grows tax-free. So if you put $100 into your Roth IRA and it grows to $150 and you take it out, you owe no tax on your $50 earnings. It grows tax-free. A traditional IRA grows tax-deferred, meaning everything you earn in that account is taxable when you decide to take it out. Well, right there, tax-free sounds better than tax-deferred to me. Another benefit is future tax savings. So taxes are expected to increase in the future. So it may make sense to prepay the IRS sum now so you don't have to pay them as much in the future. Also, unless something tragic happens, on the majority of cases, one spouse leaves a surviving spouse behind, and at that point in time, that surviving spouse becomes a single filer and doesn't get the benefit of expanded tax brackets, and that's compounded, or the effect of that is compounded by the fact that that person is still going to receive increasing required minimum distributions each year. Also, in 2019, with the passing of the Secure Act, non-spouse beneficiaries can no longer do stretch IRAs. They have to have that money depleted within 10 years, which can cause more of that money to go to the IRS than what would have gone if you would have done some strategic Roth conversions while you were alive and still had the married filing joint tax brackets. So let's go through an example here, and I'll tease out some of those examples I just gave as I go through this example on the board. So I'm just going to pull that up here real quick. And what we're looking at is someone who's 65 years old that has $1.5 million in a pre-tax traditional IRA account. We have to draw a line in the sand somewhere, so we're just using 6% as our annualized rate of return. We're assuming that this individual's in the 22% tax bracket. When we revert back to the tax laws that we had in 2017 at the end of 2025, because these current tax laws are set to expire at the end of 2025, we're going to assume that they're going to be in the 25% tax bracket, because the 25% tax bracket actually is going to start around $74,000, $75,000 worth of income. So if you're in the 22% tax bracket now, you're going to be in the 25% tax bracket in the future. And we're just going to assume 4% for state. So let's just run this out. This would be the trust the government plan. You decide to do nothing, you're not doing any Roth conversions. What happens through the end of the story? So at 65, you have $1.5 million, and let's say you just want to take out $45,000 a year, and we're going to inflate that by 3% each year to combat inflation. So you start off, you don't have a required minimum distribution until age 72, so you're taking $45,000 out each year, you pay the tax, here's what you receive right there. Now, when you reach age 72, you have to start taking a required minimum distribution. You only want to take out $55,344 to pay the tax so that you can maintain your standard of living. But the problem is your required minimum distribution is $62,669. So the IRS is going to actually make you take out an extra $7,325 just so you can pay the tax on it. Now, you don't have to spend that. You have to pay the tax. You don't have to spend it. So let's assume you don't spend it, you cross-save it for our example. And we run this all the way out until age 90. So at age 90, there's still $1.9 million left in pre-tax IRA money. Your distribution based on a 3% inflation rate would be $94,000, but your required minimum distribution is actually $161,170. So if we look at this, at the end of life expectancy at age 90, assuming that's where life expectancy ends, With that 1.9 million still left in the account, your beneficiaries are going to owe somewhere in the range of $711,000 on that pre-tax IRA money. The tax that you would have paid on your distributions, so what you took to live on and then the excess the IRS made you take out through required minimum distribution, would be $624,000. So if we look at this after-tax amount plus what you cross-saved, you would leave net to your beneficiaries that's your total taxes paid. You would leave $1,868,673. Now let's say you actually decided to do something about this problem. And you decide, I'm not going to trust the government. I'm going to go and I'm going to actually choose to pay some of the tax up front so I don't have to pay as much tax in the long run. So you're still starting out with the same $1.5 million. Now we're going to start doing Roth conversions. So you're still going to take your $45,000 out to live on, but you can actually convert an extra $175,000 to take you to the top of the 24% tax bracket. So just to show you an example of that, if we look at the tax brackets for 2022, the top of the 22% tax bracket, or the 24% tax bracket, goes to $340,100. So that's what I'm referencing. It doesn't make sense to go above this because the next tax bracket is 32%. If you're going to be in the 25% tax bracket in the future, why take yourself to the 32% tax bracket? That doesn't make very much sense, which is why we're capping that conversion at around 175, just for our example. If you were to do that conversion, you'd owe $49,000 in taxes. So 24% for federal and 4% for state. And this would be your Roth IRA account balance. And let's say you would do that for 4 years, because 4 years is the time frame that you have until these tax laws expire at the end of 2025. So if you were to do that, you would still take out your $45,000 starting off, 3% inflation. You get all the way down to life expectancy. You're still going to have to take out $94,000 to keep up with the inflation of 3%. And there's still $89,000 left in the account. We're still assuming a 6% rate of return. So the tax that your beneficiaries have to pay on that $89,000 is roughly $33,264. The tax that you paid on your total distributions, so that would be the 4 years of conversions, plus the tax on all of your withdrawals, would total $433,833. And the net left to your beneficiaries, so this $89,000 after this tax, and what's left in the Roth IRA would be $2,042,914. So by prepaying the tax, there's more net left to your beneficiaries than in the trust the government plan. It's about a $174,000 difference. Now there's a couple of things that you have to keep in mind here, because as I've mentioned in previous videos, when you tip over one financial domino, there tends to be other financial dominoes that fall, and you just don't want to be surprised by them. So if you were to go with this strategy, or if this couple was to go with this strategy, they would end up paying $42,768 more in Medicare Part B and Part D premiums if they wouldn't have done this Roth conversion strategy. Because there's something called IRMA tax, and if your modified adjusted gross income is above a certain level, right? In this case, if it's above $182,000, in our example, we're just going to assume they're between $340 and $750. Instead of paying $170.10 a month, they're paying $544.30 a month. That's going to happen for the 4 years that they're doing conversions. And their Medicare Part D premiums are also going to be affected as well. So they're going to end up paying an additional $71.30 a month. And that's for each of them. So that's why that's where that $42,000 figure comes from. So, but would you pay $42,000 extra to leave $174,000 extra at the end of life expectancy? And like I mentioned a couple of things previously, is the expectation is there's actually more savings than that taking place. We're just providing a conservative example because, as I mentioned, what happens in a surviving spouse situation, right? There's the chance that in a surviving spouse situation, if you're forced to take a required minimum distribution of $161,000, that might bump that single filer into the 28% tax bracket in the future, the 33% tax bracket. And then also, as I mentioned with the Secure Act, if you leave behind $1.9 million of pre-tax IRA money to a beneficiary, and let's say there was 4 beneficiaries, well, that's still about $500,000 a piece that they have to have depleted within 10 years. That's taking an extra $50,000 a year and just adding it to the top of their income, which is most likely going to throw them into a higher tax bracket. And a lot of beneficiaries tend to receive this money in their peak earnings years. So it's right in their late 50s, early 60s when they're earning the most that they ever have. And so they're throwing additional income on top of that. So really the savings is much more than what we can even illustrate in this example. A Roth conversion isn't for everyone. You have to run the numbers and make sense and see if it makes sense for you. And the question of the day is, are you considering a Roth conversion? Why or why not? Thank you.